Is Nike the next great opportunity to buy an iconic powerhouse on the cheap, or are they about to sink into a low-growth value trap like Cisco, Disney, and many other once great companies? Nike, ticker NKE, needs no introduction. The iconic footwear manufacturer brought us unforgettable products such as the Air Jordans, Air Force Ones, Air Maxes, and many more. Its brand strength and recognition is up there with Apple, Google, Coca-Cola, Disney, and McDonald's as the best brands in the history of humanity. According to Forbes, the Nike brand is the 13th most valuable brand in the world, and it's their brand that secures the competitive advantage that the company has achieved. Unfortunately, Nike has been struggling as of late, and it has Wall Street openly calling for a change in CEO. The move from a wholesale-first business model to a more direct-to-consumer strategy backfired when sales took a hit. Competition increased as well due to this push towards direct-to-consumer as other brands swooped in to fill the void in the wholesale markets left by Nike. The new CEO also relied too heavily on retro brands rather than focusing on product innovation. According to the Financial Times, this has blindsided Nike to increasing competition in the performance products category. Inflation has also made it more challenging for consumers to justify a $150 sneaker purchase after inflation jacked up the prices of basic living needs. They also got called out for the potential use of slave labor by the companies that manufacture their products. This has led to somewhat of a boycott by consumers in China, one of the fastest growing, most profitable, and most important markets for Nike. And finally, they completely botched the 2024 Major League Baseball jerseys. Other than a plunge in the price of Nike stock and the call for a new CEO, the result has been a recent investment in the firm by famous hedge fund activist investor Bill Ackman. As of now, Ackman says this was just a small, opportunistic investment and that he is not pushing for any management changes. Not everyone believes him. Only time will tell, but his involvement in the company could be the catalyst that steers Nike back to the powerhouse that it once was. All of this turmoil has led to Nike stock going nowhere over the past 5 years, and it's down 53% since its peak at $178 back in 2021. Nike is a very simple company. They make money by manufacturing high-quality athletic shoes and apparel at as low a cost as possible and then selling them at a considerable markup given the insatiable demand for their products. The demand is driven by their iconic brand and its association with superior quality and the names of the sports superstars that they contract with. New product innovation is also very important to the company. Nike operates in highly competitive markets where design, brand, fashion appeal, innovation, price, and marketing are the points of competition. Even with Nike's world-famous brand, if they don't innovate new products, they will quickly fall behind. Major competitors include Adidas, Deckers Outdoors, On, Asics, Lululemon, Puma, and Under Armour, among others. Nike has good revenue diversification across both geography and product type. North America accounted for 44% of revenues, while Europe, the Middle East, and Africa contributed 28%, China 15%, and Asia Pacific, along with Latin America, the remaining 13%. And at the product level, footwear accounted for 68% of revenues, while apparel accounted for 28%, and equipment contributed the remaining 4%. Now that we understand Nike's business model, let's take a high-level look at their financials before digging into the financial statements. Revenue growth has been dismal. They have been growing at 5% over the past 10 years, but revenues were flat last year, and the company guided to an outright decline in revenues in the mid-single digits this fiscal year, due primarily to the economic turmoil in China, as well as concerns that the consumer is in much worse shape than originally expected. Earnings look a little better over the long term, but the past 4 years they have been stagnant. Cash flow is where this company shines. It has been growing well over 10% over the long term, but expectations are that this rate slows more into the high single digits going forward. From a valuation perspective, it appears to be on the expensive side, with its 26 PE and nearly 3 times sales, both of which are flat to where they were 10 years ago. However, if we look at the low of their PE each of the last 10 years, excluding the pandemic, they usually bottom out in the 20 to 22 range, which is exactly where they're trading at right now. Additionally, they sport a nice 4.5% free cash flow yield, suggesting that Nike generates so much cash that it looks like a fair price on a cash basis. They have $6 billion more in cash than they do in long-term debt, giving them what is referred to as a fortress balance sheet. They currently pay a 1.8% dividend yield, which is growing at a respectable 9 9% per year over the past 10 years, and they buy back around 2% of shares each year. I'm a bit underwhelmed by the totality of the shareholder returns. I think they can bump that dividend up to 2% easily. And finally, let's take a look at the profitability. Return on invested capital is healthy with a baseline in the 20 to 25% range, which according to Morningstar is far north of their estimated 8.6% weighted average cost of capital. Operating and net margins have remained in the 10 to 12% and 8 to 10% range respectively, but Nike is determined to drive higher profit margins. They plan to achieve this through a $2 billion cost-cutting initiative, by expanding their presence in China, which is their most profitable market, and through what they call their triple-double strategy, which entails cutting out the middleman and selling direct to the consumer, cutting product creation times in half, and moving customers towards their mobile solutions. At this high level, Nike looks like a strong company going through some tough times. Perfect for the value-seeking investor to pounce on given their massive drawdown since 2021. The concern is that they're a slow-growth company now that will have a tough time fending off competition given the predicament that the customer finds itself in, and some damages to the brand as a result of a few missteps over the past several years. If you're enjoying this video and feel like you're getting some value out of this content, I'd appreciate it if you took a second to hit that like and subscribe button. It's an easy and free way you can support this channel and help me continue to bring you this type of analysis that helps you construct and grow your portfolio. Okay, let's get back to evaluating Nike. Okay, let's dig into their financial statements to better understand how they're managing their company. We start off with the income statement. Obviously, the cost of goods sold is going to be the largest expense for a manufacturer. This line item includes the cost of warehousing their inventory. Selling and general and administrative expenses include all their staff-related expenses as well as research and development costs. And given that they spend a large percentage of the revenue on advertising, I like to see that they split it out. If you calculate the percentage of revenue spent on advertising, you'll see that it averages 8% over the past 5 years. That is a significant component of their expenses. And since it's one of the main points of competition when it comes to retail products like shoes and clothes, we want to see that same level of advertising expenses going forward. If we start to see it drop off in the future, then that either means that their competitive advantage is getting stronger and stronger so they don't have to advertise as much, or they're going to start falling behind. I think they should split R&D out as well, given that even they identify it as one of the main points of competition, just like they do advertising. There isn't much else going on other than that. Next, we have the balance sheet. Shareholder equity increased $6 billion over the past 5 years, driven by a $7 billion increase in total assets, as their cash and short-term investments have increased by $4 billion, and accounts receivable, property, plant, and equipment, and deferred income tax account for the remaining $3 billion increase. What I really like seeing is that their liabilities are essentially flat from where they started 5 years ago. This means that all the value that they've created over the past 5 years has gone straight to owner's equity. But the thing that surprised me the most is that they include almost nothing under intangible assets or goodwill. As I referenced earlier, Forbes estimates their brand value at $39 billion. They're not including that in their assets. Obviously, their brand is their most important and valuable asset. It's more valuable than all their cash and investments, inventory, and property, plant, and equipment combined. Yet, they are not including it on their balance sheet. As an investor, you're essentially getting that for free, which really has my attention. When I can buy companies whose assets are growing mainly through the cash that it generates, their liabilities are steady, and I can get their world-renowned brand for free, I'm all ears. Compare that to Disney. According to the same Forbes report, Disney's brand is worth $61 billion, and if we take a look at Disney's balance sheet, you'll see an intangible asset on their balance sheet for $47 billion. You're still getting a little extra value there, but nothing like the $39 billion that you get with Nike. The last thing I like to do is calculate what I consider to be the real debt-to-equity ratio. On all the investment sites, you'll see a debt-to-equity ratio in the range of 55 to 60%. This only accounts for long-term debt. It excludes things like the portion of debt due in the next year, capital leases, and other debts not captured under long-term debt. Because of this, I go through and calculate their debt-to-equity ratio using all forms of debt on their balance sheet. If we do that for Nike, instead of the 55 to 60% that is commonly quoted, you'll find that their debt-to-equity ratio is actually 79%. I usually want to keep debt-to-equity ratio at 60% or lower, but Nike carries enough cash to cover their entire debt load, so it doesn't bother me much. As I mentioned before, a large portion of their outstanding debt doesn't come due until 2030 or later. By that time, I expect interest rates to be around half of what they are now, meaning that Nike's interest rate risk is pretty low. And finally, we have the cash flow statement. We start with the operating activities. Net income is the largest source of cash. Check. These other non-cash items are are stock-based compensation. Most other line items are immaterial until we get to cash taxes paid. I'm not sure why Schwab adds this in here. The first time I encountered this on a cash flow statement, I went to the annual report to figure out what was going on, and I couldn't. I spent hours looking around and reading until I realized that it's just for informational purposes. It doesn't factor into the total cash from operations at all. In a similar fashion, these non-cash items are just a summation of these two. And all of these are components of the changes in working capital line. The only other items that stick out are the two buildups in inventory a couple years ago. Given Nike is a retail company, they will have to build their inventory up from time to time. Moving on to investing activities. We have our standard CapEx and the sale, maturity, and purchase of investments. Nothing out of the ordinary here, but I do notice that they have sold and matured more investments than they've rebought. Makes me wonder what they're using that cash for. Won't worry about it now, but if it continues, I'd have to start looking into it further. And finally, we have the financing activities section, where the repurchase of common stock and the payment of dividends dominate the cash flows. With the exception of the $6 billion in debt that they took on for precautionary purposes right as the pandemic started in 2020, the debt section is very quiet, just the way I like it. Man, I'd sure like them to pay that $6 billion debt back. It's time to take a look at how Nike stacks up against its competition. I always do this comparison because I frequently find that I like a competitor over the stock that I'm investigating, and this is exactly what I find here with Lululemon and Deckers Outdoor. Lulu has been around for quite a while and is more of a niche brand in the athleisure clothing market, while Deckers competes with Nike in the footwear market. They own the Hoka brand that over the past couple years has been eating Nike's lunch. Both of them have better profit and cash flow margins, return on invested capital, higher expected growth rates, and they're debt-free. Better yet, Lulu trades at a similar valuation as Nike, but with higher growth rates and profitability. Nike is superior to Under Armour and Skechers with the exception of the expected growth rates. This competitor review reinforces the notion that the main reason we invest our hard-earned money in Nike is for the possible pop in stock price if Bill Ackman gets the CEO replaced, and they can turn things around and get back to the old Nike growth story. That, or if you're a value investor and you're buying because it's a decent value after its 50% drop from the peak, and you like the near 10% dividend growth. No investment is risk-free, so let's take a look at the risks involved with an investment in Nike. First, Nike guided for an outright decline in revenues in fiscal year 2025 as a result of China's economic turmoil, as well as decreased consumer interest in Nike products, and higher competition from the likes of Lululemon in the athleisure apparel market and Hoka shoes in the shoe market. Related to this fall in consumer interest is the fear that the consumer is at the end of its ability to carry the economy like it has been over the past few years. Consumers could continue to substitute to cheaper and lower quality alternatives. One of the impacts of the recent inflation is that consumers have to make tough decisions about how they spend their money. With consumer inflation, as measured by the CPI, up 23% over the past 5 years, people are having to allocate more of their income towards necessities rather than splurging on a $150 pair of shoes. There's also been problems with Nike's push towards a more direct-to-consumer strategy rather than the wholesale approach that they relied on throughout their history. They have had to backpedal on this a little bit, which means that the push to the higher margin direct-to-consumer sales channels will progress slower than originally planned, and there is the potential for even more mishaps on this front. Given their significant global manufacturing and distribution operations, Nike products are distinctly affected by tariffs, war, supply chain bottlenecks, etc. Then there is the risk that Nike no longer has the capability of growing in the high single digits. Rather, it will grow revenues around the rate of global GDP or the low single digits going forward. Other analysts, like Morningstar, think that they can get back close to the growth of past years, but even they are forecasting only a 5% annual revenue growth for the foreseeable future. And finally, Bill Ackman may sell his stake without getting any or very few of the changes that he wants, which would sink the stock even further. The final consideration in any stock is valuation. Morningstar values them $124 per share, which suggests 48% upside, while CFRA's fair value estimate comes in at 83 per share, which suggests that it's near fair value and little price appreciation should be expected. And as always, I run my own discounted cash flow model, which values them at $64 per share, but with a 20% margin of safety baked in, I'd only be willing to pay $51 a share, which is a 39% drop from current levels. In conclusion, the data suggests that Nike no longer qualifies as a high-quality company offering appealing growth prospects at a reasonable price. I wouldn't call it a value trap though. I still think the price can rebound and pass $100 per share. In my opinion, this isn't a company that I'm thrilled to add to my portfolio. It's a good and I believe safe company. Even if they turn this ship around, they're never going to get back to the sustainable revenue growth of 10%. I think it's a 6 to 7% at best, and that may be perfect for you. You can sit back with a steady Eddie company that comes with the potential for 48% upside if Morningstar is right, while you watch your dividends compound at around 9%. Not too shabby, but not great. For me, the play here is to buy it as a short-term 2 or 3 year bet that Bill Ackman can push them back into the high single-digit growth and revive their brand dominance, potentially resulting in a spike in the price. If you haven't seen my last video, I encourage you to watch it. We go over 3 asymmetric investments that can help boost your financial wealth with little risk. One of those investments is the buying of call options, and in this case, I'd focus on long-term call options of around a year. Looking at Nike's options chains, you can buy a $95 call option with a June 2025 expiration for $555. If Nike stock increases to $105 by next June, you will make an 80% return on your $555 investment versus a 25% return had you bought the stock outright. However, if Nike hits $105 before June 2025, then your gains will be much higher with the call option. We just saw Starbucks jump nearly 25% when they announced that they were replacing their CEO. We could get something similar if Ackman is able to get the Nike CEO replaced. Just a reminder though, if Nike's stock doesn't at least hit $100.55 per share, which is the stock price plus the per share premium that you have to pay, then you will lose 100% of your investment. So make sure that you can handle a $555 loss before taking this approach. Well, that will do it. I'd love to hear your thoughts on this Nike situation in the comments. I'm considering the long-term call option, but would like to get differing perspectives on this stock in case I'm missing something that I should factor into my analysis. Also, if there are any other companies you'd like me to take a look at, feel free to leave them in the comments as well, and I will eventually get around to them. Lastly, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. Until next time, you all take care. I'll see you in the next one.